Welcome to the Tradiers, the Trader's Edge. I am Jim Iuorio. That is Bob Iaccino. And notice I did not refer to you as my trusted sidekick because it irks you quite a bit.
I've got to be in the same room with you one day. You realize?
I know. Then I'll just apologize and you'll forget. That's the one good thing. Yes, exactly.
I'll just laugh.
So today was Fed Day. I'd love to talk about silly stuff, but today was Fed Day, and it was kind of a big deal, I thought. And one of the things I want to talk to our guest about, our esteemed guest about, is that the Fed ease. They didn't change the Fed funds rate, but if you're talking 25 billion in quantitative tightening was the plan, and now all of a sudden they're going down to 5 billion a month in quantitative tightening, that is easing conditions or whatever their levers are. It's pushing them less hard. That's what we saw in stocks and gold. That's the response, right?
Yeah, it is. And I like the response in gold. Obviously, I'm long gold. I'm not sure that I agree with the response in stocks. Well, let me rephrase that. The markets are right. But I think that this may be a little bit overdone to the upside on stocks. We'll see. I mean, I'm not selling it, that's for sure. But when you look at it from that perspective, when they dropped down the GDP target, increased the inflation target, right, upped the unemployment rate only to like 4.4%, not a big deal. Right. We might start using that stag word based on what they think is going to happen, which is not good for stocks.
That's not a good word. That's a word that stocks do not like. Okay, so if you guys have been following us in our media career for the last 20 years, you may have mixed opinions about Bob and Jim, because sometimes we are full of shit and we are the first to admit it. But one thing you cannot argue with is that after 25 years in media, we've made some unbelievable connections, and really high-end people say yes when we call them and ask them to go on our show. Today is no exception. We have the chairman and CEO of Macro Mavens. We have the esteemed Stephanie Pomboy. Let's bring her on. That drum charges. Maybe it's the coffee. I just had a huge cup of coffee, but that drum gets me going. What do you think, Steph? And Steph, I mentioned you in the green room. You look younger every time I see you. I think maybe you sold your soul to the devil or something, but how do you pull that off?
Keep it coming. Thank you. Flattery will get you everywhere. I appreciate it. It's totally false. And it's just this wonderful fuzzy lighting filter that somehow ended up on this camera. Obviously, as you can tell from what we just ran through behind the curtain, it wasn't anything that I put there, since I'm utterly incapable of working with anything technological.
Well, a lot of people who watch our show are young people, and they would laugh their ass off if they saw, and this is not just you. This is every show with contemporaries of us who broke into the business without a ton of technology. You should hear the profanity and the lack of knowledge of, but we always pull it together at the end, and then we come on air and everyone can see us and hear us right now. Before we go into important stuff, why bulldogs? What are the characteristics of bulldogs that you think are over other breeds, or is it just a cuteness factor?
No, well, the cuteness factor is definitely something, but the bulldog, their number one reputation is that they're stubborn. So, they're not, I have a good friend who actually is a celebrity dog trainer. He trains dogs to be in movies and that kind of stuff. And when I got my first bulldog, I asked him, can you help me train this dog? And he taught me all these things. And basically 6 months later, the dog was disobeying everything I said. And he was like, Steph, these are bulldogs. You need to pick a different breed. And I was like, no, this is my spirit animal, the stubborn, pig-headed, I'm going right, she's going left, and there will be no discussion about it. Like, I just kind of love that. So
how big is your biggest one? How much do they weigh?
Well, they get big, but I've had both. I've had two, and they've both been really small. The first one was 45 pounds, which was, I thought was small. This one's 33 pounds. So like, she's a pocket dog. I can pick her up and carry her around. And so when she's disobedient, it's not a problem because I can just pick her up. What kind of, you guys have dogs? I know that Bob has a pit.
Bob, what do you have?
Don't you have a pit?
She's a pit border collie mix.
Amazing.
Yeah, and I have a
He's really smart and really angry.
Yeah. I have like a mutt that's mostly boxer, but looks like a lab. And when we got it, we thought it was a lab from the pound. I mean, we got it, it was a stray. It was literally from the streets when my dog had the DNA tested. But the first time I threw a ball for that thing, she looks at me like, why would I go get that? Like, it was just in your hand. It seems like a better idea for you to go get it.
Are you going to go get that?
Because I was having fun. And so you pulled it out of my mouth, dude.
Oh, God. You got
She's a very lovey dog. So now that I've had a dog that would rather snuggle and watch movies, I want every dog to want to snuggle and watch movies.
Yeah.
Yeah, we don't have that with this dog. This dog will chase a tennis ball until she collapses and fucking dies. So I actually have to bring her in the house. And then she's just too hyped up. She's running all in circles. She won't lay down next to you. She won't sit still. It's almost annoying, but she's a dog. So I love her. That's it.
Yeah. Oh, no.
Yeah,
They're the best.
Way better than people.
Yeah.
It totally does. Say amen.
We joke with that, but people are great too. It's mostly a joke when I say I like people.
That's not a joke.
But I dislike more people than I dislike dogs. That's for sure. But anyway,
There you go.
Right.
so my dog couldn't walk. My dog's 12 and couldn't walk on Tuesday. And we put a bunch of painkillers, gave her a bunch of CBD, and then yesterday she could walk again. So I hate the tail end. Like when you have a dog that's 12 and 13, it is such a depressing walk to the inevitable, which I'm not trying to drag everyone down, but I just did. Sorry about that. Okay. Speaking of dragging everyone down, let's talk about the Fed. Although they boosted out.
That'll be uplifting.
Exactly. So my contention was, and I tweeted this out, about that the Fed eased. They didn't ease the Fed funds rate, which everyone expected. But if you go to 25 billion of QT down to 5 billion, and the market expected 25 billion, that's easier monetary policy than we had before. That's what these assets are reflecting, correct?
Yeah, and I think it's interesting that Powell pretends to say that this is not a monetary policy decision. Like, well, what is it? Expanding the balance sheet was clearly a monetary policy decision. So how is shrinking the balance sheet or slowing the shrinkage thereof in no way related to monetary policy? You tried to write it off as a technical adjustment, and I'm sure we'll all remember with fondness when Janet Yellen tried to describe the whole balance sheet situation as watching paint dry or grass grow or something like that. And it was, clearly they talk out of both sides of their mouth, because I would argue that the expansion of the balance sheet was a far more powerful stimulus when it happened originally than the rate cuts. And now that they're reeling it back in, they insist that it has zero effect whatsoever. And clearly that's not the case, as evidenced by their decision, just for no apparent reason whatsoever, to slow the runoff of the balance sheet. Like, if it's so innocuous and it's not affecting anything, then why are you changing it at all? And then all of a sudden, why do you out of the blue decide, well, we are already slowing it, but we're going to slow it even fast, we'll make it go even slower to draw it down. So I had said for a long time that I thought all the focus on the Fed funds rate was missing the point, because the balance sheet was going to be where the real action was. And my thought was that we would get into a situation where the economy would go into recession, and that they would cut the Fed funds rate, but not as much as they had in the past. But that they would use the balance sheet and they would re-expand the balance sheet. And the reason why I was so convinced of that had to do with our deficit financing problem, where, we're issuing $2+ trillion a year in treasuries, and foreign central banks, who were our long-term reliable creditors, have long since left the building. And I was saying just before we jumped on here that the latest TIC, the monthly capital flows report, just came out, and it showed a decline, an outflow of foreign investment into the United States. So I think it was on the order of $40 billion or something for the 1 month. And I just quickly ran through the tables, and it looked like it was all foreign officials. So again, it's our former creditors, which were foreign central banks that were buying all the treasuries. They are now running in the other direction. It would be bad enough if they simply weren't buying the treasuries. we're issuing 2 trillion. If they weren't buying any, that'd be one thing, but they're outright selling, which is therefore increasing the treasury supply even more. So if we're issuing 2 trillion and they're selling 45 billion a month, annualize that, you're looking at 500 billion on top of the 2 trillion that we need to raise in fresh money. So we're digging a hole, and then having the Fed on top of all of that effectively selling its treasury holdings by allowing this balance sheet runoff is just compounding this impossible math between the supply of treasuries that we're putting into the market every year and the completely absent demand. And you guys will recall, I think it was last summer, I trotted out my harebrained idea that we should make treasuries tax-free to try to create a domestic audience for these securities. And I did talk to Scott Besson about it before he became the Treasury Secretary. And, his sort of glib remark was, well, I think, the American voters are far more interested in no tax on tips, which I agree 100%. But at some point, we're going to have to deal with the deficit financing.
Yeah.
And I think hoping that Doge is going to find enough to cut that the problem is just going to solve itself is wishful thinking of the highest order.
Yeah, I still think it's one of the best ideas I've heard in a long time. And I don't disagree that the American public are more interested in no tax on tips, no tax on overtime. But the American public obviously doesn't grasp the issue that's coming down the pike. And again, I was just looking at the Fed's balance sheet a second ago on Fred, the St. Louis Fed's website. And we were still well above the post-pandemic levels, like well above on the Fed's balance sheet.
3 trillion, I think, isn't it?
Yeah, 3 trillion above. And I mean, I'm looking at it and I'm thinking to myself, if you needed demand in U.S. Treasuries, what could they possibly say about that idea? We're trying to already sort of bring home everything. Why wouldn't we bring home Treasury demand? Like, what would be the argument against it?
Exactly. And I mean, I think to me it made sense because we don't want to rely on China for pharmaceuticals. Why do we want to rely on them to finance our deficits? I mean, I agree with you, Bob. That's just like, makes so much sense in the context of this whole, make America great again kind of agenda. Right. And I also agree, it's a question of messaging because there isn't a single person out there who's a homeowner or has a credit card or a car that they lease that wouldn't benefit from having risk-free interest rates 100 or 200 basis points lower than they are today. And by creating an audience for Treasury paper, by making it tax-free, you could very well wring that kind of a savings out of the long end of the yield curve. And I don't know how you're going to get it down otherwise, because clearly the inflation data, even Powell was having a hard time spinning, inflation as entirely vanquished. And yet they think they're going to cut rates 2 more times, but the economy's solid, but there is no inflation. I don't know. Nothing makes any sense to me that comes out of his mouth. But
Bobby, I have a question for both of you. So you mentioned something before. So for the last, call it even 3 years, Bobby and I are being accused of being gold bugs. Several years ago, we said it's time to buy gold. And I thought we laid out the fundamental reasons very, very succinctly. So you just mentioned the lack of appetite for our treasuries globally. Okay. Is that the exact reason why you're supposed to be buying gold? Because if they're not spending the reserves on U.S. treasuries, they have to spend the reserves on something. And I'm not a de-dollarization guy. I believe that when the shit really hits the fan, they will grab dollars, and we haven't seen that yet. But is that another fuel for a leg up in gold, in your opinion?
Well, I think that is what had been driving this move. So I, like you guys, had been bullish on gold for a long time. And, I'll just say that I take a lot of flack for being bearish on the stock market, because I have viewed basically since certainly post-pandemic, but even before that it's been a bubble that's been held aloft by feckless monetary and fiscal policy. And I prefer not to speculate on a bubble because I'm not clever enough to figure out when it's going to burst. So I just would rather not have any part of it. So my preferred asset has been gold. And I get lambasted regularly for missing it on the stock market. Meanwhile, gold has outperformed the stock market, outperformed last year, even though the market was up 24%, gold was up 27. And this year, obviously, it's not even a contest. But I think what had been driving that move in gold was this diversification away from the dollar into gold by foreign central banks, especially the BRICS plus countries. And that's quantifiable. You can look at the central bank purchases by those specific countries. And so I think that was really what drove the move. And throughout, for the last, 2 years of this move, you could see that there was no money flowing into GLD. It wasn't Western investors who were saying, hey, gold looks kind of interesting. Maybe I'll buy some GLD. That didn't happen at all until just a couple weeks ago. So you're just now starting to get the Western participation. So I think if it really begins to gain some traction there, then you have the potential to have another huge upleg in gold before even contemplating the potential that we actually go into recession. And if we do that, then the whole Doge thing goes right out the window, because we're already running the biggest deficits in a non-recessionary, non-wartime, and if the economy turns down, I know Trump may not be standing for a re-election, but everyone in Congress is, and they're sure as hell not going to let the recession go unanswered, would be my guess.
So I want to ask a question, and I sent you this question early, and there's a chart that I got to put up, and it comes from Tim. It's an email question, so you're not going to see it on the screen, people, unfortunately. But Tim said, ask Stephanie how we got here. In Q1 of 2020, we spent $500 billion a quarter. Now we spend $1.124 billion per quarter. COVID is over. What the fuck?
Trillion, Bob.
Yeah, trillion. I'm sorry, trillion.
Trillion, billion.
Over, what the fuck? I'm just reading the email. He wrote billion, but yeah, it's trillion.
So I think I'm so glad you put the chart up, because what you can see on that chart is that basically you have this standard kind of classic slope, like a GDP chart, over decades, where you're going on this, what would you call it, a 45-degree angle. And, and then if you kind of extend that line, once you get to COVID in 2020, where things go bananas, if you just extend that 45-degree angle to figure out where the trend line would naturally have gone, you can see that we're now still, I don't know how many standard deviations that is, above what had been the historic sort of rate of growth of government expenditures. So two things happened, and they are two things that have happened to not just the federal government, but every person in the country. Number one, you had a surge in inflation. When we went up to 9%, and then even as we've been coming down, that obviously, it doesn't just hit households, and you don't just see it at Walmart, but all of the government outlays that are tied to cost of living adjustments. So Social Security, Medicare, income security payments, all of that got pushed up. So you're set on a whole new trajectory higher, because you had that one-time huge increase in inflation, and they had to adjust all of these cost of living allowances higher. So that was number one. Number two, and I think the most important one that everyone is aware of and talks about, is the debt service, and the fact that you had this huge increase in interest rates. So if you look, pre-2020, I think annual interest expense was in the $300 billion range. It's now more than triple that. So just the increase in interest rates had a huge impact on the run rate of the deficit. And that's the part that obviously is growing so rapidly and is out of control. The cost of living adjustments, it takes a little while, but they will be able to work their way lower, assuming inflation does come down. However, the interest expense thing, we're setting up that kind of doom loop, especially if we can't come up with people to buy the treasury paper, and we're issuing $2 trillion a year. And what's happening now is that because Yellen financed the deficits with T-bills, every day things, paper
Yep.
that was yielding whatever 1-2% is rolling at 4%. And that's why the interest expense is going berserk. And it was all a function of this insane, and I would argue felonious behavior by the Treasury Secretary of issuing, basically they were doing over 80% of our deficit was being financed with T-bills. Who does that? It's just insanity. And the thing that blows my mind is that in his first decision as Treasury Secretary, this is something Scott Bessent railed against throughout. He decided not to change it. And I think that's probably, in his defense, he's probably like, oh my God, I mean, how do I even get my arms around this problem? And let's, take a breath and step back and figure out how we're going to deal with this. But, hopefully he is going to come up with a plan that is a much more responsible financing plan.
For the people watching, I do have a question here. But what we're referring to, and we've talked about it on this show a lot of times, but sometimes people get confused about it. Secretary Yellen, there was this tremendous amount of demand for very, very short-term paper. The reverse repo had what, $2.5 trillion in it. What she chose to do was finance all our debt. She termed out essentially nothing and financed all our debt in the short term, basically zapping all that liquidity away, handing over this pile of shit to the new incoming Treasury Secretary, knowing full well that the demand on the long end wasn't as good as it had been in years past. And we know that because there's been about 4 different auctions that went poorly. Yeah. That's a good way to describe it, correct? Okay. So now here's my question. There's a couple different questions I wanted because there's so much you got there. Like we talked about Powell before. And when you look at Jay Powell, and we all agree that in June of 2021, he started making what we knew full well was the biggest mistake, hitting the gas when the CPI was already over 5% and, inflation was raging. Do you think he's incompetent? Do you think he's in over his head? And I'm not saying anything about his character. He seems like a hell of a nice guy. We get to say whatever we want. Do you think he's incompetent? Do you think he's a buffoon?
Well, I think I'm not even going to single out Jay Powell. I'm just going to say that in general, other than Paul Volcker, I can't think of a Fed chairman who's been competent, depending on the way I would define competent. I would view competent as actually delivering on their stated mandate, which is price stability, instead of all this other nonsense that they've been busy doing. And in the process, inflating one bubble after another, and then watching the bubble burst, lay waste to the economy, and then rushing in and repeating the same process all over again. So yeah, Powell, he's incompetent, but so was Bernanke, Greenspan, they all, this is why I call them monetary magoos.
Bobby?
We just got a comment I want to read from Widge. Steph Widge is a regular viewer. He's a really smart guy also. Before QE was financing our debt, the trade deficit was financing our debt. Give us significant real rates of return and we'll be buyers. I think that's one of the things that tax-free would do, is help to give us
in that direction, right?
Real rates of return. And I'm surprised, honestly, as a side note, that I guess I'm not surprised. Did you guys see Howard Lutnick, the Commerce Secretary? He did an interview and he basically said, I know what President Trump's plan is, and it's no income tax on people making under $100,000 a year. To which I immediately started calculating how much business I do that I have to give up to get to 99,900.
No, it was 150. Well, you have to go to 149.
Just for the principle of it. Steph, do you guys believe there's any, I'm sure that's what he said in meetings, but I think Howard Lutnick saying that out loud just makes him look silly. What do you guys think, Steph?
I think it's an interesting idea to talk about. Obviously, it's not anything that's viable in the near term, but I would say, I think the whole tariff thing, it is fascinating, and it relates to Widge's question a little bit about the deficits financing. The two together are important. It's like a relationship. And I think that the tariff plan kind of attempts to address that by saying, if we impose tariffs, it will help shrink the trade deficit. But in so doing, we're also cannibalizing what used to be the quid pro quo for buying US treasuries, which helped us to finance the federal fiscal deficit. So we want to shrink the trade deficit, but we don't want to lose that marginal purchasing of the treasury. So what they do is they say, we're going to use tariffs to shrink the deficit because that creates a revenue stream. And the revenue stream helps shrink the fiscal deficit. And therefore, we don't have to finance as much, issue as much treasury. So it's not as much of a problem. So I think they are being clever about how they address this by using tariffs specifically for that reason. But the idea that you could eliminate the income tax entirely, I thought he had talked about doing it entirely, not just for people under $100,000 or $150,000, and replace it with the External Revenue Service, is a delicious concept. Yeah. But I don't know that it's any time in our lifetimes, unfortunately.
It's the kind of thing I would expect to see if he was running for election, like if he was running for re-election, I should say. Jim, before you answer that, there's a specific question to you here from John Jack. Looks like, I don't know, I can't read the last name. Jim, where do you see rates in a year? So I guess you should both answer that.
Yeah, I'll start because now I'm confused. As you guys know, I thought the sheer volume of bonds we needed to sell was going to push rates much, much higher, 5.25%. I think I'm still on that path, although there's been some things that have thrown curveballs to me now. So it's somewhat confusing to me. I believe if, like, one thing that Steph said earlier, I'm going to let her then take it after that, is if we're really making headway on cutting spending. And the Doge thing, you can say it's maybe just throwing a deck chair off the Titanic because it's such small amounts compared to the actual deficit. But he did mention cutting defense spending by 8%. Germany has stepped up and said that they might cover some of their own defense spending, which we always cover. Which, by the way, I do like to take a spot to the one guy who tweeted, "I'm German, and you guys are saying we should raise an army, march through Poland, and challenge Russia." Am I hearing you correctly?
Right. That was really funny.
The best tweet of the year, by the way.
Yeah,
I thought it was fantastic. So, but anyway, so I think that right now it's delayed that rates are going up to 5% because I do think a lot of this is window dressing of the spending cuts. But I still say 5% by the end of the year. Steph, you go.
Yeah, no, I agree with you. I had that in my heart too, Jim, that I was so concerned because I sit here looking at the math and I'm, our deficit's over 2 trillion. And then I look at these TIC reports and they're selling. And I figure, like, how can this possibly persist without interest rates moving higher? You did have a huge net spec short in the 10-year, and they started to cover it a little bit. And I thought maybe that's what was explaining this move. But if you look at the CFT position, they've covered a little, but not anywhere near enough. And so I think that what's happening is two things. Number one, like you're talking about the optimism about Doge and kind of eliminating what looked to be an emerging treasury risk premium, as it were, associated with our, feckless financial situation. But the other side of it that I am very up close on right now is just the breathtakingly bad economic data right now. So if it weren't for the massive supply of treasuries we were issuing, maybe rates would be a lot lower in the face of, when the Atlanta Fed goes from +2.3 to -2.8 in the span of 48 hours, that's a little bit of an eye opener. We've never seen anything like that other than during COVID, which was an exceptional period. So it speaks to just how profoundly weak the data has been. And I'll do you one wonky better. And that is, I sit here and I look at these ridiculous government statistics. And I always do it with a full understanding of exactly how the sausage is made. So I can understand, like, do I really want to eat this piece of sausage or, And the one thing I will say in general is that when you go from the December, which is a huge holiday inflated spot, everyone's partying, Christmas parties, travel with the family, vacation, Christmas presents, G.I. Joe with a Kung Fu grip, blah, blah, blah. And then you get into January, and the economy generally goes straight off a cliff, just naturally. You just come off of the holiday high of December, and activity drops dramatically. It's like an elevator that just drops to the floor. And it's built into all the assumptions in the data. So, like payroll employment, we normally lose 3 million jobs between December 31st and January 1st. The economy just naturally, all those seasonal hirers, all those seasonal jobs disappear. Obviously, you've never seen a payroll employment print that was minus 3 million jobs in January because they assume we're going to lose 3 million jobs. So they try to figure out, do we lose more or less than we do in a typical January? And that's the number that you see printed on your screen, the first Friday of February. Anyway, what I'm trying to get to is that the January bar that they assume data will be is the lowest of any month in the year, not surprisingly. They expect retail sales to be down 15%, auto sales to be down 20%, home construction to be down, payroll employment down 3 million. And think about that and then reflect back on what the data looked like in January. Retail sales were down 1% in January on top of the 15% that they're normally down. Payroll employment disappointed. Housing sales were a disaster. I mean, if you go back and look at those prints, we've scarcely seen misses that egregious. They were so bad that they took the Citigroup surprise index from like plus 44 to minus 16 in the blink of an eye. So my point is, if the data looked that bad in January when the bar was set so low, heaven help us as we move into the spring and construction's supposed to start and consumers are supposed to open their wallets and spend more. And then you see things like Hooters going out of business. And I mean, if tits and ass aren't bringing them to the tables, I don't know what is going on. I mean, we got problems, guys.
I want that cut out as a short. What did we put out on Twitter? I want that.
100% a short. Real quick,
man.
I think you guys are going to be right, but I think in the short term, you're both wrong. I mean, I see yields are down 35 basis points since the inauguration, if you use the 10-year as the benchmark. And I think that's deliberate, although I don't know how. I mean, it's not deliberate as in they drag the yields down with their bare hands, but I think this is something Bessent and Trump wanted. I don't know if Trump wanted it, but Bessent wanted it and Trump agreed.
And Bob, are you saying that they wanted to then break up the economy a bit, break up the stock market?
Yeah, I do.
They haven't mentioned the stock market. Okay.
And again, like Jimmy, you and I have talked about this, but I haven't mentioned it to Steph in any of our conversations. Trump tweeted it in this first 100 days, 63, 67 times about the stock market. Not once right now. I think he's actually been convinced that unemployment, especially when you look at wages, still going the wrong direction. I'm sorry, not unemployment, inflation, especially when you look at wages. Wages are still 4% plus in terms of and up and to the right in terms of wage growth. So we need prices to come down and wage growth to continue to catch up to get the consumer stabilized. And then you guys are going to be right. But I see a possibility of a sub 4% 10-year before we go to 5%.
Well,
but you're wrong.
Nothing would get it down there faster than the stock market continuing to crap out.
Exactly.
I mean, that's the thing. And this idea, I think it's really interesting to watch the way the media spins what's going on here, because you suddenly have, I consume a fair amount of conservative media outlets, let's put it that way. And they were all on the, Biden economy sucked, we're headed into a recession train. And now, if you suggest that retail sales down 1% in January is a recessionary reading, that's like, oh my God, that's just liberal talking points. So, I think one idea that they have is that it doesn't matter that the stock market is correcting. That's just natural and healthy. But if you think that we can have the stock market go down and not have a recession in the economy, you are smoking crack. Right. I mean, come on. And I think Scott Bessent even acknowledged this. He didn't use this phrase, but basically said the stock market is the tail wagging the dog, the economy dog. And it really is. And anyone who imagines that, it's just fine for the stock market to correct and it won't have any economic consequence is delusional.
right, I got
That's
some
funny.
long questions, Shani, and we've got a lot of questions for you, Steph. So I'm going to go with the long form version from Peter Lake first. He's got 3 questions in here, but we'll do this one. Macro novice here, not sure if the question is appropriate. No dumb questions, Peter. Here it
I
is.
disagree, Peter. If it's dumb, we'll tell you, but I haven't read it yet.
How would you do a compare contrast on a doom loop in the US versus a country that is not a reserve currency? There must be differences in the kind of macro analysis in the US versus another developed country. Question 2, is there any incentive that would suggest the Chinese would be more open to a convertible? I don't think this is a novice question.
You're not a novice, Peter, you're a liar.
And pull the Band-Aid off because the bond market is big now, so money could come into Chinese bonds. Maybe I'll stop right there and I'll read the rest of it.
Steph?
Oh, yo, thanks. For giving me the quote unquote novice question.
I like the doom loop question.
Oh,
because we were all talking about a doom loop 6 months ago when there was no even talk of stopping spending. And now that there is talk of stopping spending, we've kind of put the doom loop scenario on hold a little bit, thankfully, thank God. But it's still, of course, possible if we have to start issuing too many bonds to make up for our debt, and then all of a sudden, boom, boom, boom. But the question is we have the reserve currency. Countries that don't, it seems like it's a lot bigger deal. What do you think?
Although the one example I was going to think of is the country that's actually kind of gotten there, and that's Japan. But they benefit from the fact that they're internally financed. So in a way, there again, it doesn't really create the crisis that you would think it would. So that's a tricky question. And as to
the novice.
Well, and I think the Chinese convertible yuan thing, I mean, I think basically this is what the BRICS have been trying to get to, because the only way you can establish a currency that really is a real alternative to the US dollar is creating markets that are equally deep and liquid. You know, that's the thing, is you need to have the deep and liquid markets that you can recycle all of these currencies into. And so I guess that's part of what they're trying to do with the BRICS Plus consortium. And obviously they're not there yet. But the other side of what they're doing that's kind of interesting, that almost makes that less important, is that I think what they're trying to do is create a trade block where you get whatever they're calling it, a unit of BRIC currency. And that's the currency that you transact to buy goods within that union, as it were. So, you know, you're not getting, when you trade with India, if you're China trading with India, you get your BRIC thing back. Well, then you can turn around and use it to buy oil from Russia or whatever. Right. So they do have these ways where you can transact like that. But in terms of like a financial market that you can invest in, it's still a long way away. But they are building out some of that.
There's 2 things I'd say. One is that I think the globe has to ask themselves who'd they rather have be the arbiter of global trade. Okay. Is it the United States and the dollar, which we have made some mistakes. We've made some mistakes with Europe, freezing them out of the SWIFT payment system, locking down dollar denominated assets. That threw a question mark, but it's still not the question mark to the tone of what China is. Right. I don't think the globe is going to sign up for China to be the arbiter of global trade. Secondly, if someone else asked me this question about Chinese yuan convertibility and shit, I would say, let me call my friend Peter, because he seems to know a shit ton more about it than I do, Mr. Novice. Right?
Mr. Novice just put down here in the bottom, we can put this up on the screen or not. Japan had a secret debt jubilee. I was not invited. International debt still denominated in USD, I think, and I'm not totally a novice. He just
we got that part. First of all, we're going to take a timeout in the show because I want to run the banner for Tradier Pro. Okay, you guys, we do the show every week. We tell people we will not talk about a product that we don't fully believe in. Try Tradier Pro for 3 months for free. If you trade options at all, whether you're a novice, intermediate, or an expert like Peter is, you can use Tradier Pro, and it is an amazing system. Again, it is 3 months free. There's absolutely no obligation. All you have to do is try it out. Consider it as a favor to us, because again, we do these things for Tradier, and the payback is that we get people to try their stuff, not because they need traffic, because it's good shit, and you guys will like it. So try Tradier Pro for 3 months for free. I should pitch more stuff. What do you? I can do this. Dude, have me be your pitch man, people. Anyway, Bobby, back to you.
So I want to throw up Tim's question. By the way, we just got a lot of questions now, so I'm not going to have any more on my own. Consumer confidence literally fell off a cliff last week. I'm giving Max a second to find it in the comments here. Literally fell off a cliff last week. Will the hard data fall off a cliff as well? Max, you missed it. Put up Tim McLean's comment, Max. So he's at consumer confidence fell off a cliff. He's asking if the hard data will. If you guys don't mind, I think the hard data is already leaning off the cliff. I don't know if it's going to fall off a cliff because there are a couple of things like mortgage rates, for example, that have gone from 7% to 660. Not a big deal. I just got an email from a home builder down here in Florida that said blowout sale. And there were just homes all over the email page that I got, all these homes that they couldn't seem to get rid of. We got long lead times here for homes, but there are things that the lower medium to long-term interest rates can help the consumer with. But I do think the data is going to start to fall. And that's a switch for me. Like I've been all about reflation and inflation getting stronger. I think we're actually going into a reasonable slowdown in the next 6 to 12 months. What do you think, Steph?
Well, I would agree with that. And I thought, going back to sort of Chair Powell's comments in the presser, he was asked about what do you make of that University of Michigan survey and the implosion thereof. And he sort of brushed it off as not having much real world relevance to actual spending. False. Actually, you can overlay, this is what I do for a living is look at relationships between those kind of survey data and actual spending. And there definitely is a relationship. I mean, it doesn't have to be one for one, but generally you don't see confidence implode like that and spending not slow down. But the most important and most powerful relationship of any of the indicators, any of the components in that University of Michigan thing is the perception about the labor market. And I thought this was really interesting because perceptions about the labor market fell to the worst since the global financial crisis in 2008. So like worst in 20 years, basically, the worst recession we've seen outside COVID. And that's just out of the blue. And it's at a time when the unemployment rate is 4.1. I mean, he characterized it as basically being at full employment. So the consumers know before the BLS figures it out what's happening in the labor market. And I think that the University of Michigan, that one component is telling you to expect much, much weaker employment data going forward. And I don't think it's just a federal government DOGE thing. It's going to be, much more widespread. And I think the Fed will be, again, finding out that they missed it because they dismissed what was a really important indicator.
So to add to what
she just said, a lot of shit, don't they?
Damn straight. If they're going to be firing, and the DOGE is all these NGOs, we're taking the money away. Federal government, we want to get rid of whatever, how many ever million jobs. And granted, it's going to be over 8 months. You cannot do that without at the same time be deregulating the private sector, lowering corporate taxes in order to provide incentive for them to absorb these jobs over the next year. They're doing it in backwards order, in my opinion. They should be hitting that hard at the same time they're letting those people go. Am I crazy?
Yeah, no. I've been very frustrated that the first thing out of the gate wasn't the tax cuts.
Yeah, it should have been the first thing. Yeah.
And especially, I'm no fan of the stock market, which I think is a bubble and really needs to get back to more reasonable valuations. But I would say that, by not putting taxes first, they're missing it because the stock market needs that. They need to know, like, if you're running a business, you need to know that these tax cuts are not going to expire. At a minimum, you need to know the tax cuts are not going to expire before you make a decision. I mean, that's a big deal about hiring or CapEx or what you're going to do over the course of the year. And I don't know why they decided to put tariffs first, other than that maybe they need the revenue from the tariffs to justify the tax cuts. So
could be
maybe, but fine. Just come up with a spreadsheet, calculate what the tariffs are going to generate, and then go forward with their tax cuts.
And Bobby's going to read another question, but if you have to go at any time, just like give us the high sign or something, and we'll yeah. But if you're having fun, we're having fun too. I could talk to you all day.
Tippy toe.
Yeah, you get it. Right?
All right. So, man, there's a lot in here. First, Peter Lake came back with this. I love this. Awesome show. This person is very smart. Learning a ton. Thanks for doing it.
Talk about me, not Stephanie.
I was just going to say that. I was like, I don't know who this person is.
You would say he's talking about you, but I, of course, would say he's talking about me.
I would say he's talking about one of you because I'm humble and muscular.
Okay.
You are. Yeah.
It's a question up or a comment, I should say, from Widge. He says, I think we're both going to see some crazy data going both. I think we're going to see some crazy data going both directions because we haven't seen this kind of an attempt at an economic change in our lifetime. That's a great comment. You guys got any comment on that?
Yeah.
Steph?
Yeah, and I don't know. I mean, this is what we're starting to see is a little bit of volatility, uncertainty, and frankly, I love it. I think it's great. It's healthy to actually have to be a little reactive and not have everything be status quo, especially when status quo is a completely artificially supported and manipulated market. It's not a real world market. And so injecting a little uncertainty and making people actually have to bend a little bit and be a little thoughtful is not the worst thing in the world.
But Widge, you know my opinion on that. I've been saying it since the beginning of the year. Everyone thought, oh, Donald Trump's president, things are great and there's blue skies. Not so fast. 2025 is going to be a huge transitional year, perhaps the biggest one in our lifetime, even if we are going from what I thought was moronic and destructive economic policy over the last 4 years. And by the way, that's provable. Anyone want to take the other side of that, you are going to lose in a fiery crash in that debate. Now, going to a better economic policy is great, but there are pitfalls, hurdles, potholes, all that shit along the way. And we're going to experience them throughout this year, I think.
I'm laughing in the background here because Peter Lake confirmed that he meant Stephanie.
Well,
that person. I knew he meant Stephanie.
One thing I was going to say on that pothole, potholes on the way to Nirvanaville is that you will see, in addition to the layoffs from the federal government, you were talking, Jim, about the kind of ripple effects from there. One of the primary beneficiaries of all the fiscal funny money has been the state and local governments. And they were huge contributors to employment. So that's going to be another issue. It's not just the federal government, but state and local governments are not going to be on the gravy train anymore. That's going to be a huge hit. And the thing that really results from that is that state and local governments are required to run balanced budget mandates in contrast to the federal government. So when the Fed stops sending them money, if the economy slows and their receipts go down in any way, or God forbid, their pension funding shortfall goes up in any way, they immediately have to cut spending or raise taxes or do some combination thereof. So we could see a drag exerted on the economy that has nothing to do with what DOGE is doing at the federal level and everything to do with the state and local belt tightening that is just naturally going to happen anyway as a result of all this. So.
All right, from John Case, is there any chance Congress will take back fiscal policy to control the spending or leave the dual mandate to the Fed who cannot succeed? I love the last part of that question, by the way, to the Fed who cannot succeed. Fiscal policy doesn't belong to Congress technically, but go ahead.
What do you mean? So Congress does control the spending. That's the fiscal
They control
policy.
the purse strings, but fiscal policy is still within the executive branch. In other words, and this is a conversation we had with Vivek Ramaswamy years ago, and he said before he ran for president, he wanted to make sure, and again, the Supreme Court could say differently, but he wanted to make sure that in certain cases, he went to constitutional lawyer after constitutional lawyer. The Congress says we shall allocate this amount of money. It doesn't say that the president has to actually spend it. In other words, there's money allocated to different things. The president can say, I'm spending this much on this. He theoretically can say, that money you sent, I'm not spending it. I'm sending it back to you. Now we'll see it because it's going to go to court. Go ahead.
I could be wrong, but I think maybe what John is getting at there is the inflation embedding sorry, the question about inflation. Boy, am I dyslexic today. That he's saying the fiscal policy, like if Congress can get its fiscal house in order, they can help control the inflation problem. Or are they going to have to leave that to the Fed, who cannot succeed? That's how I read that question, but maybe that's not all where he was going. And I mean, yeah, if we can get a fiscal policy to be responsible, then, well, on the other hand, I was going to say then we would be good. But, you know, don't underestimate the Fed's ability to completely screw things up. So,
Bobby, are we running up against clock? Because I want to ask like a quick question. We're going to bring it back to markets for a second.
Go ahead.
Steph, you're looking, let's say from this year and to the middle of 2026. If you had to pick 5 assets, I'm not saying to hang your entire career on. If you had to pick 5 assets that you think are going to do pretty well in this environment. I mean, we've already established gold. I assume your opinion hasn't changed on that, correct?
No.
So 4 more. What do you think you'd want to own going into this environment?
Okay. That's tricky.
It's going to be easy, didn't you?
So gold number 1, gold miners. I'm going to say, actually, I'm going to say
you're cheating, but I like your cheating. Yeah. Okay. Go on.
This is where I'm going. Gold miners. I've been long gold and kind of a very small portion of miners. I'm trying to rejigger my allocation to have predominantly miners and, you know, let's say a quarter in gold, 75% miner, that kind of ratio. And then other than that, I guess I would say, in terms of absolute performance, I would probably be long oil. And just because despite all these protestations about coming to peace accords all over the world, oil just refuses to go lower. So I'm kind of impressed with that action, especially in the face of the weakness we're seeing globally. So that would be one. You know, I like commodities in general, but oil and gold in particular. And then on a relative performance basis, I would be overweight emerging markets versus developed economies. But that's 4, and I'm really pushing to get to 4.
Yeah, 4's good. Yeah, right. I would have a hard time with 4, Bobby.
Yeah, I'm going to say, so first of all, gold, I agree with. Jimmy knows.
And that means silver as well, correct? Yeah.
Not for me, because I lose money every time I trade silver. So it's just gold for me, because I don't understand the relationship well enough, and I'm man enough to admit it. But it's gold. And then I want to kind of tell people that for me, I'm not ready to buy the stock market yet, but I am starting to buy individual stocks. Like, for example, I bought General Dynamics yesterday. I bought Raytheon 2 days ago. I might be getting back in Palantir to Tim McLean's dismay. There's a small biotech company I like, Legend Biotech, LEGN. These little individual stocks that you can actually make big upswings when the market recovers. Now, it may not be tomorrow, it may not be 2025, but when the stock market recovers, if you have solid companies you're starting to buy now, you can get a big upswing in that. And if I'm wrong, I mean, I got so much money in gold right now. So I'm good.
Should we wrap it?
Yeah.
Yeah, I wanted to make one more thing that I would be like number 3 beneath gold miners, gold. And it would be short corporate credit. The question is, how do you do it? So that's a little tricky, but I think we're going to see a real blowout in credit spreads.
So the CME has credit futures contracts that trade a bit. So you wouldn't do it in JNK or HYG?
I mean, I guess you could.
You have to, I guess, right?
Yeah, I guess. I mean, so I don't do those things because I feel like gold is an expression of the same trade, basically.
Yeah,
but I just wanted to make the point that I'm bearish on credit spreads, and I think that's going to be a story as we go through the course.
And I'll add to that too, is that I try to have credit spreads up in a chart somewhere, because I think that could be the lead, is when the shit's hitting the fan. That's what credit spreads start to blow out first, and I think it gives us a little bit of a leg up on when risk assets are going to go lower. Seems reasonable, right?
Yep, and they have moved up considerably. Yep. So
good.
We'll
Peter
see.
Lake, one more question from Peter.
I'm just going to put up one more comment.
I've had enough of Peter at this point.
It's just got to be one more comment, and we'll do Peter's comment, and then we'll do Tim McLean's comment. Peter's last comment is,
Peter, we love you.
You guys are too cool to own gold. So that's what he put up there. And then
He's
Tim
wrong.
McLean says short corporate credit via short
Aries, Apollo, yeah.
KKR. Yeah.
Yeah. And those stocks have all come down a lot.
Yeah.
Tim
Cool. That's
McLean.
it, Jenna. That's
Tim's
it, Jenna.
smart guy. Thank you for that, Tim, because that is actually a
Yeah, he is a
brilliant,
smart
brilliant take. Yeah. Anyway, this is Tradie Airs, the Trader's Edge. I'm Jim Iuorio. That's from Chicago. Bobby from Florida. Stephanie from the mountains somewhere?
Nope, Florida.
Florida.
I'm on the other coast.
Oh, but you spend some time in the mountains, don't you?
I do. I will be decamping for Colorado in June.
That's fantastic. We're gonna drive a home in Tabernash, which is near Winter Park.
Oh,
so
yeah.
I don't spend my daughters spend a ton of time there with all their friends, but I don't spend as much as I want to. But this summer I'm going to be there for a few weeks.
Well,
so
you'll have to let me know.
I would like that. That'd be fun. Yeah. I'd like to talk to you other than on a podcast with 5,000 people watching. But anyway, so it is great to have you guys. Thank you guys so much. Remember what Bobby and I's mission was? We were in legacy media for 25 years. Legacy media, we're always at the whim of some overzealous producer or a sponsor telling us what we could or couldn't say. As you can imagine, guys like Bobby and I don't love that very much. So now here we might be full of shit, but it's at least honest shit that we're saying, and we appreciate you guys supporting it. It's humbling. That's Steph Pomboy, who is the CEO, president of Macro Mavens. Tell them where they can find you, Steph, before I give the final goodbye.
Please do. Go check me out. Macromavens.com. You can read all about what I do, and you can subscribe. There's a novel idea. Or you can follow me on Twitter at @spomboy, or right here with these dudes.
Yeah. Very much appreciated. Thank you guys again, people. Thanks for joining us.
Hey, LJ said hit the like button, everybody. So
hit the like button. Yeah.
I don't even know what that means.
I don't either, but whatever. I've heard of it.
Perfect.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.